I'm going to show you guys a checklist for one of the A+ ICT models that I use. The criteria for it is that we find a daily/weekly bias. From there, we go down to a lower time frame and hunt for setups in the direction of that daily/weekly bias. I'm also going to show you guys from my experience of trading ICT for a year what specific conditions to avoid. This is the most important part, yet by 99% of the videos on YouTube, this part gets left out because a lot of people don't have the experience to understand when it plays out versus when it doesn't. We're going to dive into that in this video. Before we get started, all credit goes to my mentor, the Inner Circle Trader on YouTube. If you want to study his 2022 mentorship, that's the source from which I've learned all this stuff that I'm teaching you guys here. So let's dive into how to find daily and weekly bias for this model, because that is the first step of the checklist. If you want a more in-depth video on draw and liquidity, I do have one about 3 weeks ago. If you click on the profile for my YouTube, you'll find how to find draw and liquidity. You can check that out afterwards if you are interested. So you'll notice on the weekly time frame, price took out an old low. This is sell side liquidity. It's expanded higher. Okay, it's expanded away from that old low, and we have this engineered liquidity above, meaning there's a cluster of highs above. So we have this high, and this high that price is kind of displacing towards, and along the way, it's disrespecting bearish PD arrays. So we do have a volume imbalance right here. If price was in a sell program, meaning when I say sell program, I mean smart money short and price is just continuing to offer lower prices. It's in a sell side delivery program. When it's in a sell side delivery program, price is returning to things like volume imbalances, which we have here. It's also returning to bearish breakers and fair value gaps, and it's retesting them as resistance. Notice how here it's not doing that. It's pulling up, it's not heading lower. It's actually negating those bearish PD arrays and just moving away from them. So the fact that it's disrespecting some of these bearish PD arrays on the left side of the chart, and it's delivering from the old low down here, meaning smart money took out retail's sell stops, and it's expanded away from that, disrespecting the bearish PD arrays. So when price comes back down into here on the daily time frame and weekly time frame, I'm noticing, okay, we have the engineered liquidity above here, right? We have this old high that it's gotten really close to, and this entire drop down, I'm looking to see, does price take out a sell side liquidity level? Because really this entire retrace back down was just to take out this old low. So on the daily or weekly time frame, I'm looking to see, okay, does price expand beneath this old low, or do we start to reverse back higher? So from the weekly time frame, I'm marking out this previous low. You could also mark out PD arrays on this time frame. So if you look at this last up close candle in here, this is a mitigation block. You'll notice that price traded down to the low end of that and then started to expand off of that. Why is it a mitigation block? I'm not going to dive too deep into this, but basically price made a high, a low, a higher high, and then a higher low compared to that low, and then it expanded higher. That makes it a mitigation block. The last up close candle or the consecutive up close candles. The last up close candle is the sweet spot. The consecutive up close candles is the mitigation block. So you can mark out PD arrays on the weekly or daily time frame. My focus for this model is looking at liquidity first. So liquidity is the most important, just like we talked about over here. It was delivering from the liquidity, and then it started to expand higher. When it comes back down to internal liquidity, since I believe that price is in a buy program, this is an area where I can start to look for a reversal at. So when price takes out this old low on the weekly, I'm dropping down into a daily, and I want to see if we get a shift in market structure higher. I want to see if order flow is continuing to prove, after it takes out the sell stops, that prices switch from sell to buy program. So on the daily time frame, we have this swing high right in here. What does price do? It displaces past this high. So the same model that I'm going to be looking at on the higher time frame, we're looking at on the lower time frame. It's a completely fractal checklist. The same thing that we're looking at on the daily, right, is going to appear on the lower time frame. I'm going to show you guys specifically where to look for it though, so stay tuned. On the weekly, we took out this old low. Another thing that we could add, if you look at the NASDAQ and you look at the weekly time frame, if we zoom back out to there, another thing you could look for is SMT divergence. So ES took out this previous low over here. If you look at the NQ price chart, NQ is all the way up here. So we have a cracking correlation between correlated assets. These usually move together. Since ES took out the sell side and then started to expand away from it, right, and NQ didn't, that's more confluence to suggest potential higher prices. But what we want to wait for is a shift in market structure, which we do get right here. So we have this previous high right here. This gets taken out. Price goes lower and then expands higher. So the next thing that I'm looking for is a fair value gap within this price leg. So after it takes out the sell side or the old low, and price starts to expand higher and it breaks through a previous lower high. So to put it in simple terms, price created a low, high, lower low. When price creates that higher high, before it takes out this previous high or within that price leg, I'm looking for a fair value gap. If it creates this is a signature that indicates to me that smart money is going to take price higher. So notice what has happened here. It took out the old low, it's expanded higher, taking out this previous high, creating a market structure shift. While it did that, it created this big imbalance. When I see this imbalance, to me, what it means is that this move up was institutionally sponsored, meaning smart money bought the sell stops. Where do they need to take it? If they have bought from sellers at a lower price, they need to take it to buyers at a higher price. Why? So they could sell to buyers at a higher price. If they're buying from sellers low, right, to put it simply, they need to sell to buyers high, right? That's the market efficiency paradigm, right? Retail traders are getting trapped short down here. Smart money's buying from those retail traders selling. They're taking it higher to sell to retail traders buying at a higher price. So you may say, well, how do you find a bias before it does all of these green days higher? Well, you just apply the same logic that I just talked about and go down to a 4-hour chart. That's how you come up with bias without having to use the daily or weekly. Use that same logic. What did price do? Took out sell stops, created a market structure shift higher, and created a fair value gap, right? The same logic, and we don't have to wait for all the way up here. So why do I care about daily and weekly then, Dan? Well, because the daily and weekly, right, gives me a higher time frame bias. So though I could have got long in here using that same ideology, right, and it targets this high for the first level of buy stops, if we ignore that, or not even ignore it, let's just say that we waited for it to break above this high. Now, on the daily, it indicates even higher because it indicates these highs, whereas the 4-hour time frame just indicated this previous high right here. Hopefully that makes sense. Before we do continue, if you guys would like to see more content from me, I do have a Discord, which will be the first link down below. We've been bullish on the S&P 500 and the NASDAQ since late October, just continuing to look for higher prices in this futures tab. So if you guys are interested in seeing that, my Discord is the first link down below. Also, intraday, I do cover ICT setups, right? Here was one from earlier today on the NASDAQ at 3:34 p.m., seeing if price can make a run for the buy stops now. After just returning to internal liquidity, it created a market structure shift with a fair value gap. So we were looking for higher prices in here, and you can see later it did start to expand for that. We did take one loss and one win in the PM session, but then there was a nice short setup in the AM session. So I was looking for lower prices based off of the same lower time frame model that we just talked about, right? Price created a market structure shift, fair value gap. Price was likely to aim for that liquidity lower, and those are some trades that I did take in the AM session based off of that logic. If you guys are interested in that, check out the Discord down below. So now we're going to go ahead after November 2nd, right? We have the bias that price is going to want to trade up into these highs because that's where buy side liquidity rests. And if smart money's long, that's where they're going to want to take price. We had the run on sell side liquidity, market structure shift on the daily with a bullish fair value gap. Now it's likely to expand for here. I'm also going to go over what to do after it hits that target, so stay tuned. So this is what the lower time frame model checklist looks like. We're looking for 2022 models in the direction of that bias, which is liquidity taken, a market structure shift with a fair value gap. So that being said, let's dive into price action after November 2nd, because that's when we had the bias that price is going to start targeting higher prices. So if I'm looking at a chart live and I see this candle right here, I already have these signals to indicate that price is likely to trade up to here. Now what I'm doing is I'm scaling down into a lower time frame. Now, in my opinion, it does not matter as much to look for PD arrays along the way here. You absolutely could. You absolutely could look for 4-hour fair value gaps, 4-hour order blocks, right? 1-hour order blocks, 1-hour fair value gaps. For this model, you're specifically looking for liquidity to be taken along the way and then target the buy side above. So there was no model on Friday, but if we do skip ahead to the 6th, which is Monday, we're still targeting that high up there. What I'm looking to do is I'm looking to mark out liquidity pools. So on the hourly time frame, we have this old low. If price takes out that old low, this is an area on the lower time frame where I will hunt for this signature, a market structure shift with a fair value gap. So we have that liquidity marked out. We can now go down to a lower time frame using the 1-minute time frame here. I trade the New York session. This will work on any session. So if we skip this ahead, price is trading down, right? Takes out an old low. I'm looking for expansion higher, creating a market structure shift with a fair value gap. So we have a market structure shift right here. Price is traded higher. Took out this short-term high over here, but also we do have this little swing high in place. right here. So this would be the market structure shift level because it has a lower high to the left and a lower high to the right of that. In that price leg higher, I'm looking for a fair value gap to get created. We have the fair value gap back down here. So if price were to return back into any fair value gap in this price leg from this swing low to this swing high that created the market structure shift, I would long that fair value gap. Where can I target? Well, I'm looking to target buy side above. So I could either look on the 1 minute and target the buy side here, or I could trade in the direction of that higher time frame bias, and I could look on a higher time frame such as a 15-minute, and I could target liquidity above here. Just if you want to target low-hanging fruit targets and you're new, the best thing to do is just target some of the 1 minute or 5 minute liquidity pools above the market price. So when price trades higher, right, I'm waiting for price to drop back down lower. We do have this bullish fair value gap right here. You could long this, but with this model, when price takes out the sell side, this is the sell side liquidity. When price takes it out and then price creates the market structure shift higher, the safest stop is going to be at the swing low. So some of the conditions to avoid is when price is all the way up here, don't long that and then just have your stop right down here. So this would be an example of a condition to avoid. If price is just consolidating after creating that market structure shift, you want to make sure that you have high enough RR to have your stop all the way down at this swing low. So let's just say that you entered right here. I'm not going to say that you would have got a perfect entry holding or waiting for it to return back into that fair value gap. So we would enter in this bullish fair value gap right here, and then we would be targeting the liquidity above. So we have these relative equal highs right here. That would be a low-hanging fruit target because they're relatively close to each other. This is a 1 to 1.5 RR trade. In the strategy that I use, it is at least a 1 to 1.5 RR trade every single time. It could be as high as a 1 to 5. So I just cannot go lower than a 1 to 1.5. If we let this play out from here, price consolidated. It got very close to the previous low. Remember, that is where our stop is supposed to be, at that previous low. And then price starts to expand higher and takes out the buy stops. So really right here, we just had a extremely deep retrace on stops. Some people will have their stop right beneath the fair value gap. There are certain conditions where that's okay, where you can have your stop beneath there in a strong market. But just to be safe, have it at the previous swing low. So they return it all the way back down. This is a rejection block. This is a PD array, reversed in, and then it expanded much higher. So that would be a plus 1.5R trade. Remember, we're filtering out any type of bearish setup in here. So some people may be looking at this as a bearish 2022 model when it returns to a fair value gap. We are only looking for 2022 models in the direction of that higher time frame bias. We created the market structure shift here, had a bullish fair value gap, and we had relative equal highs above the market price. That's a high probability draw on liquidity. Zooming back out to the higher time frame, this is where the liquidity got purged, took out the sell side. Now I want to see if it creates a market structure shift up higher, which it does post market. So this is 4 p.m. It creates a market structure shift by breaking through this previous high in here. In that price leg, we're looking for a fair value gap. Has it right there. So now what is the likely draw on liquidity? Since we're expecting price to trade higher into there and it took out liquidity, created a market structure shift higher, I'm looking for price to start targeting buy stops. So since we have a higher time frame bullish bias that price is trading up to here, when price takes out sell side liquidity, creates a market structure shift, this is enough for me to start targeting old highs. So this will be the draw on liquidity above now. So this is at 9:30 open. It has returned back down into a discount of the range. I don't really use premium and discount for my specific model using the 2022 mentorship. But when price returns back into this fair value gap down here, I want to have our stop at the swing low all the way down here. And we're targeting the buy stops above. So this previous high right here would be the target, and we're buying when it returns into that fair value gap. Now you could look for lower time frame setups in here. For this example, I'm just using a 15-minute time frame. It's taken out liquidity, created a market structure shift, right? We have the swing high in place right here, and it has the fair value gap right there. So when price returns back into it, this is an area where it's likely to act as support and then start to expand higher. So if we let this play out from here, see that it expanded straight for the buy stops. So you could hold for higher targets in here. You could draw some standard deviations on this, which I will do a future video on. But just to have a low-hanging fruit target, you're aiming for the buy side above the market, which is the closest to the market price. So we have a 1.9R trade right here. We have these relative equal highs, and you can see price, this place is straight for that. Skipping ahead to the next day, price is above this previous high. It returns back down. It takes out sell side liquidity, creates a market structure shift higher with a bullish fair value gap. So it takes out this previous swing high in here. This would be the market structure shift. and it has the fair value gaps. This is a high probability model, but it's not within the New York session, so I would not have traded this, but the target would be the buy side above. We let this play out, expand straight for the buy side. Now, when price starts to pull back down lower and it starts consolidating, right, or it starts trading around the 50% point, this is where I start to avoid certain conditions, because I will not take a long setup now that it took out buy side and it's back to equilibrium. So when it does that and it returns back to equilibrium, these are conditions where I just avoid. I do not trade in here until it either takes out the sell side liquidity here, right, or starts to expand higher away from that. So when price take, this is something you want to write down in your notes. When price takes out a level of buy side like that, and then it returns back to equilibrium, I either wait for it to take out all the sell side below or expand back towards this previous high to start looking for setups again. So I either needed price to do two of those things and it returned back down to the sell stops, took out that previous low, so now it can start to hunt for lower time frame setups again. Again, we're looking for a market structure shift. So if price breaks through this previous high in here with a fair value gap, that'd be enough for me to be bullish and start targeting buy side above. So price took out the sell side liquidity on the 1 minute time frame. I'm looking for a market structure shift with a fair value gap. We have the fair value gap right here. I'm waiting for a market structure shift. So if we skip this ahead a little bit, see price just consolidating. Once it breaks through this previous high, that's enough for me to be bullish. So as price is retracing back down, right, this would be an area to long. Why is this an area to long? Because it took out sell stops on the higher time frame, created a market structure shift right here. In that price leg, we have a fair value gap. So at this point, I don't really care to long the fair value gap. For me, it doesn't necessarily have to return to the fair value gap. I just need to be able to target the buy stops above, right, or old highs above, and have good RR, right? So if I enter long right here, I can either target this previous high or this previous one. Since they're relatively close to each other, I'm going to think that it's going to take out both of the highs. So you can see that it does take out the buy side. This was a 1.66R trade. So zooming out from the 1 hour time frame, it engineered all this sell side liquidity, came back down, took it all out, created a bullish 2022 model. Price created a shift in market structure. We had a bullish fair value gap right here. Also created another break of structure higher and created a fair value gap. So this would be a beautiful hourly time frame long, entering in on this hourly fair value gap, putting your stop beneath this previous low, and we're using the same checklist that we just talked about. Liquidity purged, market structure shift with a fair value gap, targeting buy stops. So we have this previous high right here. It's about a 1 to 2.5 RR trade. If you hold for the external high right here, it's about a 1 to 3 RR trade. Now, Dan, what happens once it reaches that daily bias target? Well, there's a few things that could happen. It could consolidate, reverse, or expand higher. We wait for two of those things. Either it reverses or it expands through that previous high. If it consolidates, I do nothing. So I want to see what it does here. It expands much higher. If it expands through this previous high with speed, it shows me that smart money did not want to sell to the buy stops above here, because there's buy stops above old highs, and rather that the draw on liquidity is higher. So the draw on liquidity target is higher from there. So since price just expanded straight above it, well, it shows me that smart money did not sell to the buyers above here. So which liquidity is likely to be next? Well, we have the buy stops above these two previous highs right here. So this is relative equal highs. So I'm thinking going into the next days that, okay, the daily is likely to expand towards these highs. Now I can go on to a 1 hour time frame in here and look for more bullish setups along the way. We're not going to do that because we just covered a bunch of examples, but if I skip price ahead, you can see that it ends up trading into this previous high right in here. So that's how I utilize the higher time frame and then scale down into the lower time frame for setups. So now let's dive into conditions to avoid, and the first one is before high impact news. So if we look at today is Tuesday, November 28th. We had high impact news at 10 a.m. So red folder news, you can go to forexfactory.com. I was not trading before 10 a.m. I just kind of like to wait for the volatility to settle. This is for this specific model that I use, right? There are multiple models that I use, but this is an expansion model, and I do not like to trade before high impact news because sometimes it could do one more run on stops. It just makes it lower probability for this specific model in my experience. Another thing, when price returns back to 50% and starts consolidating, these are conditions that I avoid. Another thing, when it's perfectly creating engineered liquidity on both sides of the market, those are also conditions I avoid. Let's look at some examples of what that looks like. Right here, we have this previous old high. This is live price action in the NASDAQ. Price pulled up higher and it returned back to equilibrium. So when price does this, when price takes out buy side liquidity and it returns back to equilibrium right here, just like I talked about earlier in the video, As price is at equilibrium in here, I am not looking too long, or I'm not looking to short, because it's returned equilibrium and it's delivering from buy side. I don't know from here if they're going to target sell stops or if price is going to pull back up for an old high. So you'd be avoiding price action in here. And it's still doing that. It's still just consolidating at 50%. So this is an expansion model. This is not a consolidation model. There's other models for consolidation, which I could dive into in the future. But for this model, you'd be avoiding all of this price action because all it's doing is just consolidating around 50%. Now, if we zoom in up here, it returned back to 50%. Once it expands away from 50%, and start to reach for this previous high in here, that's enough for me to go into the lower time frame and start hunting for setups. So if we dive into a lower time frame from here, I'm either waiting for price to expand far away from that equilibrium and start reaching for that previous high, or take out all the sell side below. What does it do? It expands away from equilibrium and reaches for this previous high. So I can go down to a 5-minute time frame, and now I'm looking for a 2022 model too long in here. So in the 5-minute time frame, price came back down, took out sell side liquidity. If we go down into a lower time frame to look for fair value gaps, you go down to a 2-minute, 1-minute, 3-minute. If we go down to a 1-minute, you have a fair value gap right in here. This is a little bullish fair value gap, and price created the market structure shift by breaking above this previous high. So this will be enough for me to long and hold for that higher time frame drawn liquidity target. So we have the buy stops above here. Right, if we extend that out, that is likely where price is headed because it's moved away from equilibrium, right? And it's expanding back for this previous high. So that's enough for it to indicate to me that's where it wants to go. On a 1-minute, right, we created the market structure shift higher, created a bullish fair value gap in that price leg. What I'm going to do now is I'm going to put my stop beneath this previous low. I'm going to long the fair value gap. Now, my RR, I could enter at this previous high because my RR up to that high would be a 1 to 3 about. So if we let this play out from here, I believe at 9:30 open, it starts to expand much higher and a rip straight for that buy side. So that's what you could do when you're avoiding certain conditions, right? When it's consolidating at equilibrium, if it expands away from it and reaches for this previous high with speed, that's enough for me to be bullish for that high. As long as it's around 50% though, I'm not looking to trade unless it either does that, expands higher, reaching for that previous high, or it takes out the sell side liquidity down here. So the last one is when there's perfect engineered liquidity on both sides of the market. That's exactly what's going on right now in the NASDAQ on the 1-hour chart. So for this specific model, I would not be trading this. There's two things that it's doing. It's consolidating at equilibrium or around equilibrium, and it's also clustering a bunch of highs close together right here. So we have all of these highs above, and then we have all of these lows clustered below. So you don't know which one smart money is going to reach for first. So you're either waiting for the two things that I talked about. You're either waiting for it to completely take out all of this sell side liquidity, right? Or you're waiting for it to expand much higher. So as long as it's between this range, right? This is not high probability conditions for this specific model. That's going to be it for this video. Hopefully you guys found this insightful, and I will catch you guys next time.